I want to share an interesting discovery with you. Every few years, a wave of speculation floods the precious metals community, claiming that gold and silver are about to be officially revalued by governments, and everyone holding physical metals will wake up millionaires overnight. I've watched this narrative cycle through at least 4 major iterations in my career, and right now, we're seeing another surge. Before you mortgage your house to buy more bullion, we need to dissect what's actually being claimed, where these theories originate, and why the structural mechanics of modern monetary systems make most of these predictions fundamentally impossible. Let me be direct with you. I'm bullish on precious metals as portfolio insurance. I hold gold and silver personally. But the revaluation mythology that is spreading right now contains dangerous assumptions that could lead you to make catastrophic financial decisions. The people promoting these theories aren't necessarily scammers. Many genuinely believe what they're saying, but they're operating from flawed premises about how central banks, international monetary agreements, and sovereign debt actually function in 2025. The core claim goes something like this. Gold is currently suppressed far below its real value. And at some point, governments will be forced to officially revalue gold dramatically higher, perhaps to $10,000, $20,000, or even $50,000 per ounce to back their currencies or settle international debts. Silver, by extension, will rocket upward in proportion. Those holding physical metals will see their wealth multiply exponentially, while everyone in paper assets gets wiped out. Here's what this really means. We need to separate the legitimate observation that gold prices are influenced by institutional forces from the fantastical claim that a coordinated official revaluation is coming. These are completely different propositions. Yes, central banks manipulate gold markets. This isn't conspiracy theory, it's documented policy. The London gold pool of the 1960s was an explicit agreement among central banks to suppress gold prices by flooding the market with metal from their reserves. It eventually failed when physical demand overwhelmed their ability to supply, leading to the collapse of the Bretton Woods system. We have the meeting minutes, we have the policy papers. This happened. Today's mechanisms are more sophisticated. Futures markets allow price discovery to occur in paper contracts that vastly exceed available physical supply. The Bank for International Settlements coordinates central bank gold swaps and leases that aren't transparently reported. These activities absolutely influence prices, typically with a suppressive effect, because monetary authorities have a vested interest in maintaining confidence in fiat currencies. But acknowledging manipulation exists is entirely different from claiming that authorities are planning an official revaluation event. The revaluation narrative confuses how governments actually use their gold reserves in modern monetary architecture. Here's the crucial part. No major economy operates on a gold standard or maintains currency convertibility to gold. Gold on central bank balance sheets is marked at historical acquisition prices, not market prices, specifically because revaluing it isn't operationally necessary or even desirable from the perspective of monetary authorities. Now, let me explain the mechanics. When the U.S. Treasury holds gold, it is valued on the books at 22 per ounce, the statutory price set in 1973. The Federal Reserve's gold certificates are similarly valued. This isn't because the government doesn't know gold trades at $2,600 in the market. It's because the accounting value is irrelevant to how monetary policy actually operates. The Fed doesn't need gold backing to create reserves or conduct open market operations. The Treasury doesn't need gold revenue to fund operations. It issues bonds in its own currency. Could the Treasury simply declare gold is now worth $20,000 per ounce on its books? Technically, yes. The Gold Reserve Act gives the Secretary of Treasury authority to alter the statutory price. But what would this accomplish? It would create an accounting gain on the Treasury's balance sheet. That's it. It doesn't create spendable revenue unless they sell the gold at market prices. It doesn't just back the dollar because the dollar is not convertible to gold at any ratio. It's purely cosmetic accounting. The revaluation theorists often point to this mechanism as proof of concept, but they miss what doesn't happen afterward. An accounting revaluation doesn't force market prices upward. Private markets don't care that the U.S. government decided to value its hoard at a different number for internal bookkeeping. The gold price is discovered through supply and demand in global markets where hundreds of millions of ounces trade annually. A U.S. accounting entry doesn't change Chinese demand, mining supply, or jewelry fabrication rates. But there's more to this. The historical precedent that revaluation advocates cite actually undermines their case. In 1934, Roosevelt revalued gold from $20, $67 to $35 per ounce as part of the Gold Reserve Act. Revaluation proponents present this as evidence that governments can and do officially change gold prices. True enough, but context matters enormously. That 1934 revaluation occurred within a completely different monetary system. The dollar was legally defined as a specific weight of gold. International settlements occurred in physical gold. The revaluation was part of a broader confiscation and monetary restructuring during the Depression. The government raised the dollar price of gold specifically to devalue the dollar against gold, making gold reserves translate to more dollar liquidity, which was a deflationary crisis response. None of those conditions exist today. We're not on a gold standard. Currencies float against each other based on market forces and central bank interventions. International settlements happen in reserve currencies and SDRs. The entire architecture is different. Using 1934 as a template for what might happen in 2025 is like using sailing ship navigation techniques to predict how GPS satellites will function. The fundamental technology changed. Now let's address the international angle, because this is where the revaluation mythology gets particularly elaborate. Some versions claim that a new Bretton Woods-style agreement is being negotiated in secret, perhaps led by China and Russia, where gold will be officially revalued as part of a reset of the global monetary system. Nations will settle trade imbalances in gold at the new higher price, and currencies will be backed by gold reserves. I understand the appeal of this narrative. The dollar-dominated system benefits the United States disproportionately. Many countries have motivation to change the structure. China and Russia have been accumulating gold reserves. These facts are all accurate. The conclusion drawn from them is where things go off the rails. International monetary agreements require consensus among major economies, because unilateral action leads to isolation from global trade and capital flows. For a gold revaluation scheme to work as described, you'd need the US, EU, China, Japan, and probably 20 other significant economies to agree simultaneously. Their economic structures, debt positions, and strategic interests are wildly different. What's advantageous for China is potentially catastrophic for Japan. What helps Russia might destroy the EU banking system. Let me give you a concrete example of why coordinated revaluation is structurally unworkable. Japan holds minimal gold reserves relative to its economy, about 765 tons. China holds approximately 2,200 tons officially, probably more unofficially. The US holds about 8,100 tons. If these three agreed to revalue gold to, say, $20,000 per ounce as the basis for currency backing or trade settlement, the US gold reserves would suddenly represent $5, $2 trillion in value. China's would be worth about $1. $4 trillion, and Japan's would be worth roughly $490 billion. This creates massively asymmetric advantages that track almost perfectly with existing geopolitical power structures. Japan would never agree to a framework that further subordinates it to US monetary dominance. China wouldn't accept a system where America's existing gold hoard gives it 6 times the monetary foundation that China has, especially when China's economy is approaching parity with the US in real terms. The only way to make it equitable would be to redistribute gold before the revaluation, getting the US to transfer thousands of tons to China, Japan, and others to balance things out. Does anyone seriously believe the US Congress would vote to ship Fort Knox gold to Beijing? These proposals fall apart the moment you think through the second-order effects. Here's what you need to know. The revaluation narrative also fundamentally misunderstands what gives currencies value in modern economies. We haven't operated on commodity money for generations. Fiat currencies derive value from the productive capacity of the economies they represent, the rule of law in those jurisdictions, the taxation authority of the sovereign, and network effects of existing usage. When you accept dollars for your labor or goods, you do so because you're confident you can exchange those dollars for other goods and services, because the US government demands tax payment in dollars, because dollar-denominated contracts are enforceable in courts, and because dollar liquidity is deep enough to facilitate massive transactions instantly. Gold backing is completely irrelevant to any of these functions. If tomorrow the Treasury announced gold was revalued to $50,000 per ounce on government books, but nothing else changed, the dollar still isn't convertible to gold, you still can't redeem your dollars for metal at any government window. Why would you suddenly value your dollars differently? You wouldn't. The backing is theoretical, not functional. Now I need to address what might actually happen, because dismissing the revaluation mythology doesn't mean gold prices are going nowhere. It means the mechanism for price increases will be market-driven, not administratively declared. Gold prices can absolutely reach $10,000 or beyond, but they'll get there through the messy, chaotic process of markets responding to monetary conditions, not because finance ministers gather in Basel and decree a new price. If central banks continue expanding money supply faster than economic growth, which their debt burdens essentially force them to do, hard assets, including gold, will appreciate in nominal terms. This is straightforward monetary inflation reflected in asset prices. Similarly, if confidence in sovereign debt deteriorates as deficits prove unsustainable, flight to hard assets accelerates. We're seeing early signs of this in how gold has been rising, despite real interest rates being positive, which traditionally suppresses gold. Something is shifting in the risk calculus of major holders. That can drive prices substantially higher through actual buying demand, not official decree. Here's the crucial part about why this distinction matters for your investment decisions. If you're buying gold expecting a specific revaluation event, you're likely to make poor timing and allocation choices. You might overconcentrate into metals expecting an imminent announcement. You might ignore other hard assets that would benefit equally from monetary degradation. You might hold through periods where tactical positioning in other assets would serve you better. If instead you understand gold as insurance against currency debasement and systemic instability, you'll hold an appropriate allocation regardless of time frame, you'll rebalance sensibly, and you won't be perpetually disappointed when the predicted revaluation event fails to materialize on schedule. Let me share something I have observed over multiple cycles. Every major market dislocation of the past 30 years has spawned a new wave of revaluation predictions. After the 2008 financial crisis, we heard this would force a gold revaluation to recapitalize banks. Didn't happen. Governments chose infinite QE instead. During the 2011 European debt crisis, same claims about an emergency revaluation to save the Eurozone. Didn't happen. ECB did whatever it takes, bond buying instead. COVID monetary explosion in 2020, more revaluation predictions, still waiting. The pattern is consistent. Crisis creates legitimate concerns about currency stability, which drives some people toward gold, which creates a receptive audience for dramatic revaluation narratives, which spread through alternative financial media, which ultimately disappoint when governments choose different crisis responses. This changes everything about how you should filter information in this space. What governments actually do in crises is expand the toolkit of fiat manipulation. They invent new forms of money printing. They restructure debts through inflation. They implement financial repression, forcing captive pools of capital into sovereign bonds at negative real rates. They coordinate currency interventions. They change accounting rules to make insolvent institutions appear healthy. These are the tools they've invested in and refined over decades. Gold revaluation is not in the playbook because they've deliberately built a system that doesn't require it. Could that system eventually fail catastrophically enough that they're forced back to commodity money? Yes, it's possible. Fiat currency regimes have failed throughout history when mismanagement becomes extreme enough. But that's a chaotic breakdown scenario, not an orderly official revaluation. If we reach the point where the dollar, euro, and yen have lost so much confidence that governments must return to gold backing, we're talking about a complete collapse of the existing order. That's not a scenario where your gold revaluation gains get deposited smoothly into your brokerage account. That's a scenario where the entire financial infrastructure is unreliable, property rights are contested, and capital controls are pervasive. The sanitized revaluation narrative where governments announce gold is now $20,000, your bullion dealer updates their prices, and you're suddenly wealthy while everything else continues normally, that's fantasy. The real version of monetary system failure is Yugoslavia in the 1990s, Zimbabwe in the 2000s, or Venezuela in the 2010s. Gold holders did benefit in those scenarios relative to people in pure fiat, but the benefits came with extreme dysfunction in everything else. This is what you need to know about the institutions perpetuating revaluation narratives. Many have commercial incentives. Precious metals dealers see sales surge when revaluation excitement builds. Newsletter services gain subscriptions by offering insider information about coming revaluations. These aren't necessarily scams. The people involved often believe their own predictions, but you need to account for motivated reasoning. I've seen internal sales training materials from some bullion companies that explicitly instruct salespeople to emphasize revaluation scenarios when closing hesitant buyers. The pitch is designed to create urgency. If you believe revaluation is imminent and specific, you're more likely to buy maximum quantities immediately rather than dollar cost averaging over time. From a sales optimization perspective, it's effective. From an accuracy perspective, it's led to countless disappointed investors who bought at peaks during revaluation excitement. Let's also examine the evidential basis for most revaluation claims. When you trace sources, you typically find a chain something like this. An alternative financial blog cites a YouTube video by a metals dealer who references a newsletter writer who interpreted a translated speech by a Chinese central banker who mentioned gold's important role in the monetary system. By the time this passes through 4 layers of interpretation and motivated reasoning, it's transformed into China announced gold revaluation imminent. I'm not suggesting you only trust mainstream sources. Those have their own biases and blindnesses. I am suggesting you demand primary sources for extraordinary claims. If someone says central banks are secretly planning a revaluation, ask for the specific documentary evidence. Meeting minutes, policy papers, legislative texts. Vague statements about gold's importance don't constitute evidence of revaluation plans. Here's what this means moving forward. Maintain a healthy allocation to physical precious metals as part of a diversified hard asset strategy. but base that allocation on the fundamentals that actually drive long-term value: monetary expansion relative to economic growth, real interest rate trends, systemic risk in over-leveraged financial systems, currency debasement through fiscal dominance of monetary policy. These factors will determine gold's trajectory over the coming decade, not secret revaluation agreements. The case for gold remains strong without requiring conspiracy theories or official price decrees. We're watching fiscal deficits that cannot be financed at reasonable interest rates without central bank intervention. We're seeing debt-to-GDP ratios that historically resolve through inflation or default. We're experiencing a gradual loss of dollar dominance in international trade, not through coordinated replacement, but through incremental diversification by trading partners who have experienced weaponization of dollar clearing systems. All of this supports systematically higher real prices for monetary metals over time. But it's a grinding process of market recognition, not a sudden revaluation event. The wealth transfer happens slowly through inflation differential, not overnight, through administrative decree. If you're positioning for what's actually coming, rather than what makes the most exciting narrative, you'll hold metals as core insurance, you'll rebalance when allocations drift too far from targets, you'll avoid overconcentration that leaves you vulnerable to liquidity crunches, and you'll maintain diversification into other hard assets and productive assets that also benefit from monetary degradation. The revaluation narrative wants you to bet everything on a single dramatic event. Reality suggests you should prepare for chronic deterioration with periodic acute crises. Very different positioning strategies result from these different worldviews. Stay skeptical, demand evidence, understand the actual mechanisms of monetary systems rather than projecting how you wish they worked, and recognize that the strongest case for gold does not require government cooperation. It's built on governments doing exactly what they've always done when faced with unsustainable debts.